The opinions expressed on two-way traffic are those of Darren Coleman and are for general information purposes only. It does not constitute any legally binding engagement between the podcasters and anyone else. Always check with your advisors to obtain your own tax or investment advice. Welcome to Two-Way Traffic with Darren Coleman of Portage Cross-Border Wealth Management. In this series, Darren aims to guide you through the complexities, complications, implications, and most importantly, the advantages of having money and family on both sides of the border. In this episode, tax lawyer Anna Malazhavaya joins Darren. They'll discuss the capital gains inclusion rate, the expanded powers of the CRA, and more.
Hi, everyone. It's Darren, and welcome back to another episode of Two-Way Traffic, the cross-border podcast. I'm delighted to be joined today by tax lawyer Anna Malazhavaya. Anna, I got that right? I think I was close.
You got that right, Darren. Hi, thank you for having me.
For sure. Thanks for joining us. You're the founder of Advotax. Did I get that one right? I got your name right, but the firm wrong.
Advotax.
Advotax
Law. We're a tax boutique.
You're a tax, but I'm kidding. I knew it was Advotax Law, but I figured I'd get the hard one first and the easy one wrong. Anyway, thank you for joining us. I'm delighted that you're with us. There's a lot for us to talk today about tax issues, primarily for Canadians, but there is a cross-border component that we're going to talk about. Some of the things that have been in the press recently that have impacted Canadian taxpayers, and I want to get your perspective on what your clients are thinking about. For example, the capital gains change that we saw very recently, and the deadline for people making changes to get the old rules is over. So now we're in the new environment where the inclusion rate or the amount of money that you have to pay tax on has gone up. And the government told us when they brought this in, this was only going to affect about 0.13% of taxpayers. So really not very many. Is that your experience so far? Or do you think their math was right on how many people were affected? Or maybe they're not telling us everything?
I have doubts, Darren. I have doubts. I'm not an economist and I don't have access to all the government stats, but I do have doubts and I can share some stats and maybe your listeners will have some comments as well. Capital gain may apply on the sale of your investment property, i.e. a property that's not your house, your principal residence
right.
Where you live.
Yeah, your cottage, your second or third rental property that you have.
Correct. So based on RE/MAX report, more than 4 million Canadians hold more than one properties. So 4 million Canadians potentially, as they hold that property and sell that property, may be subject to that new increased capital gain rates.
So hang on. So what you're telling me is that if there's 4 million people with a second property and there's, call it 40 million people in Canada, just to pick a round number, because I don't like doing math in public, that's not 0.13% as far as I can tell. That's more than that. Am I right?
It's way more. And of course, if I argued for the other side, I would say, well, you don't know how much money these people made on the property, and the first 250,000 is still subject to the old rate. And that's true. But at the same time, something tells me that if these people held the property for more than 10 years, which I'm sure many did, that gain will be substantial. Look at how real estate market performed in the last 20 years. The gain is substantial, and a lot of these people will be subject to the new rules. Not only that, think about the people who only have one property and let's say live on a farm property and they have their house, but they don't, and they have a land. But when they sell their property, not the entire sale price will be sheltered by the principal residence exemption, but only the portion that's required for the maintenance of their farm property. Everything in excess will be subject to capital gain and can potentially be subject to these new higher rates. And, I have many examples. Think about people who have their investments and now they pass away.
Yes.
And we know we have deemed disposition rules on death, that capital gain will be subject to the higher rates.
Yeah, and I think you're right. This is an area where I think many Canadians are going to experience this higher tax. When grandma or grandpa or mom and dad or somebody passes away, and that cottage that's been in the family for a generation or two, or their investment property they had that funded their retirement, it's sold, and they're now going to experience. Wait a second, we're going to have a much higher tax rate on this asset that's been in the family for a long time. And from our perspective, a big part of that rate of return was just inflation. So they're being taxed on a higher rate just on the value of the dollar changing over time. So this is going to affect a lot more people, isn't it? I'm curious if you're aware of, and I know the answer, but do you know how they arrived at their 0.13% number? Do you know how they came up with the data point for that?
They may have analyzed prior returns and to see the percentage of gain that was reported in excess of $250,000.
That's exactly right.
Okay, so that was a lucky guess. But I'm curious how those years that were chosen, how they were chosen.
Okay, this is the point. You would make, I think, a reasonable assumption that they may have looked at past taxpayer data and said, if we look at the last 5 or 10 or 15 years, how many taxpayers had a capital gain over 250,000? Let's average it out over a bunch of years, and maybe we get the number. That would seem reasonable to most people, I guess, but that's not what they did. They looked at 1 year, 2022, and said, well, in that year, only 0.18% or 0.13% of taxpayers had a capital gain reported of over $250,000. Well, interestingly, and again, I don't know if this was on purpose, but that was also a negative year for stock markets globally. And it was also a bit of a negative year for real estate equity markets everywhere. So that's interesting. So the year that they picked, they didn't average a bunch of years. They picked 1 year, which also happened to be a pretty poor year for people to realize capital gains because a lot of times there weren't any. So, interesting. So I think the average listener or the average taxpayer can look at that percentage number and maybe think it's not as what I believe and you believe and other people I've spoken to believe this is going to hit a larger number of Canadians than maybe they forecast. So we'll see how that. But you'd mentioned something interesting around this has really impacted your clients in a way that's kind of surprising. And it may not be about the math, it's about their emotional reaction to it. Tell me a little more about how your clients are experiencing this change.
A lot of my clients, well, let me tell you this. I've been practicing since 2008. And I started on Bay Street, and then I started my own firm. And on all these years, until maybe 2022, I probably had maybe the total of 5 people consulting with me who wanted to leave Canada. Normally, it was the other way around. We had all those talented people who wanted to bring their money, settle their life in Canada, educate their children here, build their future, build businesses, hire people, pay taxes at 54%, mind you. They wanted to do that.
Right.
This year alone, I was just counting, I have over a dozen new clients. And I'm sure people who specialize in cross-border issues, to them it's a small number, but for me, given my practice, it's a big change of people calling me practically every week saying, I'm done. You know what? This capital gain change, it did not affect me today. It probably won't affect me tomorrow, but it's the last straw that broke the camel's back. I am remote. I can make my money anywhere in the world. I can be in the U.S. I can be on the beach, anywhere in the world, and still make the same money. I don't need to be paying through my nose in Canada on my investment income, on the money, on the gains that I realize, on my business income. I'm down. I'm out of here. That's what I see. And it's almost like an emotional response, but it's happening. It's happening. People are leaving Canada, the wealthiest, the most talented people, the people who used to pay 54% to the Canadian government, the people who used to hire people, who used to come up with brilliant solutions, making the life of everyone better. They're leaving Canada. Very sad to see.
Well, and you're not alone in experiencing that. I had a conversation this morning with a cross-border tax accountant in North Toronto, and he said he's had a surge of people looking to leave Canada, and he blames it on, yes, the tax policies are making it less attractive for them to be here. But he said, I don't think the government realizes how easy it is for people to go, because there's nomad visas where you can work in Italy or Portugal or Dubai. The tax rates are far lower. And as people discovered in COVID, if I can work on my laptop from anywhere, then you know what? I can work on my laptop from anywhere. So why not do that? Now, this is also an area that you work on for people that say, I'd like to leave Canada and I'd like to maybe go to the United States. So take us a bit. Is it that easy to just pack up and go to a place like Florida, for example? Or what's the process if someone wanted to do it?
Well, as of June 25th this year, the process became a lot more expensive. So, if you want to leave Canada, you are treated by Canadian law as if you sold all of your assets, even though you're not selling anything. You keep in all your assets. But the government says, okay, fine, you want to leave Canada, but we want all the tax on the gain that you accrued to date. We want you to pay it, then we'll let you go. Some call it a departure tax, although this isn't an official name of it. But really, it can hit you hard if you decide to leave Canada. So you have to declare all the gain, all your assets. If there's gain on those assets, you have to pay tax on it. You have to declare to the CRA that your plans to not to be a resident of Canada. You have to pay your tax. And then you're free. You're free from the burden of Canadian taxation. It can be that departure tax can be quite heavy. So that's a deterrent for some people to move. Right. But given the ever increasing tax rates, some people are now doing the math and saying, listen, it's cheaper to pay tax once and then move to a much more tax-friendly jurisdiction. Than to continue being exposed to these surprises, never-ending tax hikes.
And when people do that math to say, what do I have to pay my deemed disposition on, there's a few assets that do not get added into that. So people won't pay the tax. And I think the biggest one is their RSPs and their RIFs, right? So they can, if they've got a lot of money in their registered retirement accounts, they don't have that tax that they have to pay. Right. So what happens to their money when they leave Canada and they leave their RSPs here? Would they still have a 50+% tax rate on that, or what would it be?
So it will depend on so they will no longer have their contribution room if they no longer a resident, as they get funds from their RSP. It really depends on whether or not it will be subject to tax in their new home jurisdiction.
That's right. So they need to know what the tax treaty says in the new place, because it is income.
It is income. And as far as Canada is, it will depend on how much money they take out of their RSP. It's not a bad solution for the people who have all their savings in their RSP to consider that departure. And given how mobile the modern world is, a lot of people are choosing that.
We've done some math. On that, we've done some math for people that have gone and made those changes. They have the ability to move to another country, and many Canadians have dual citizenship. They may have come here from somewhere else and they have another passport. I have a second passport for another country, so people can do that. And we did the math for one gentleman who left, and he said, "Hang on, if I stay in Canada, I'm gonna, because of his other income, because I'm gonna pay 53.5% roughly on every dollar I take out of my RSPs when I retire, or I can move to this other jurisdiction and I pay 25%. Well, that's a pretty significant difference.
Yeah.
And depending on the jurisdiction you go to, you may see even lower numbers than that potentially. So, so this is something I think when people are going through this process, they get really good advice. There's an interesting difference we experience when people want to give up American citizenship versus Canadian residency. So Americans are taxed on citizenship. So anywhere they go, they pay tax. But Canadians are taxed on residency. So it's how do you evidence to the tax authorities, I'm still Canadian, I just don't live here anymore. So there is a process to go through, right, to make sure that you've done that. And that's something that you would help people go through correctly so they don't miss a step, right?
Yes, what we like to use, so we made a privacy request, a request under the Privacy Act to get a copy of the algorithm that CRA auditors use, the very same algorithm that's on their
Really?
desk that they click through. So you can request a copy of that algorithm through the Privacy Act request. So we have that, and we use
Oh,
that
that's
when we.
inside baseball stuff. I didn't know you had that because I know there's a set of guidelines that they kind of tell you, but you've got the secret sauce for this.
We have their algorithm, the very same the auditor uses when they look at your file. So that's the same one we use when we help our clients, with the caveat that after all, it's still the CRA's position, right? It may be different from the real, from how the law really applies. Now, of course, not many people would want to pick a fight with the CRA,
No.
but some would. So our job is to highlight the risks to them.
Right. But I think it's really important people get this right the first time, because you don't want to go through the process and then find out 5 years later you didn't really leave the way we thought you left and you owe all that tax back, right?
Yeah. No, we don't want these surprises.
So this is interesting because you're saying people are upset, they're wanting to leave because of the change in capital gains. Well, let's talk about something else that might also make people a bit crazy, which is this concept of bare trust reporting. So that was something that kind of came out of nowhere, it seems, for many tax preparers and individuals. And it seemed to quiet down, but it hasn't gone away. Do you want to take us through what bare trust reporting, what that was all about?
Sure. In very simple terms, when we talk to someone and someone says, I put the house in the name of my uncle. Have you heard that expression? Yeah. So that arrangement that you have when it's your house, but you put your house in the name of your uncle for some reasons, be it creditor proofing or family, I don't know. So for whatever reason, you've chosen not to put your name on the legal title of the house, and you put your uncle's name. But you and your uncle probably sat down and thought things through, and you told your uncle, Uncle Bob, I'm going to put your name, the house in your name. Please let me do that. And I need this for these reasons. But just so we're clear, this isn't your house. This is my house, right? So if the house is rented, the rent goes to me. If the house is sold, the money goes to me. If, God forbid, somebody gets injured on a house, and the owner gets sued, I'm the one paying that person who got injured, because really, we all know it's my house.
Right.
So this arrangement, when certain property is put in somebody else's name, is what we lawyers call a bare trust. That's what it was called in common law, and really, in more legal terms, it means that the trustee, the bare trustee, in my example, Uncle Bob, doesn't really have any rights, doesn't have any responsibilities. He's just there holding the title to the property, cannot do anything else, not allowed to do anything else.
Yeah, he's holding somebody else's keys. Yeah.
Yes. So that's the bare trust arrangement. And I will be honest and say that sometimes this arrangement was used by people who were less than honest, and maybe even some criminals. So, and maybe even there was some money laundering or tax evasion going on using these bare trust structures, when the mafia boss will not put their house in their name and would put the house in their wife's name or uncle's name or somebody else. So because of those few bad apples, our government got very worried about bare trust structures and said that now everyone, and we mean everyone, whoever holds property in the name of somebody else, has to file a report, file a tax return. And if you don't, we're going to apply very serious penalties.
And it's a very specific tax return. It's not on your regular one. You have to do a trust return in addition to your regular tax return, right?
Oh, yeah. So for some countries, there are similar reporting rules, but they just say, tick a little box to say that, you have this arrangement with your family member or with anyone else, with your business partner. But can the revenue agency or finance department rather went all the way and said, no, we want a new tax return and we want you to come up with a name for the trust, be it Bear Trust for Jane Doe or Bear Trust Jane Doe, so that they have some weird names about how to name that trust. And for most people, where the rules may become important is situations when they hold a bank account,
right,
for their parent,
yep,
or their child, or it's a joint bank account with mom's money in it, but you are on title for the bank account only because mom doesn't know how to do banking anymore.
Right. And this is what we saw happen, right? Is that this idea of they're trying to stop or get a sense of people that are using this technique nefariously. Instantly, they captured hundreds of thousands of people that are like, no, mom doesn't go to the bank anymore. I'll go on her account to help them with it's still her money. This is now a bare trust, and it required a name. It required a tax return. This isn't what we thought, or people have an account for their kids to hold the birthday money. This now becomes a bare trust and requires reporting. And then this began
questionable. That is questionable. So all those accounts where we have several, where our legal owner is different from our beneficial owner, when the requirements, the filing requirements came into place, the poor bank departments, poor bank legal departments got flooded with emails and phone calls from little old ladies who were saying, I don't know what's happening. These people are telling me I need to file some tax return. People were completely confused. They didn't know what bare trusts were. Their accountants didn't know what bare trusts were.
And that's a good point, right? Because we had that too, where people are saying, like, do I have a bare trust or not? I'm like, your accountant can't make that. You need to have an attorney make that determination. So I think it's fair to say that they maybe went a little aggressive on something, and it scared a lot of people into the reporting. Now, have they kept to that? Because this was just this last tax year. So a lot of people did a lot of work. A lot of accountants and lawyers did a lot of work to get people to comply with the rules. And then just as they got to the finish line, what happened?
The government changed their mind 6 days before, 6 days before the deadline. The deadline was April 2nd for the returns. I believe, don't quote me on the dates, speaking from my memory, March 24th is when the government announced that we can ignore the requirement for this year. Not that the rules are canceled, the rules are still in the act in that green book. Yep. But for this year alone, it was waived. The requirement is waived. So because the announcement was made 6 days before the deadline, a lot of people, most honest and law-abiding Canadians, already went to their accountants, paid them a lot of money, went to their lawyers, paid them a lot of money, and filed those returns, those that they didn't have to file after all. A colleague of mine, Joseph Devaney, he is one of the founders of Video Tax News. It's a tax education organization for tax professionals. They did a study on LinkedIn. They did a survey on LinkedIn on the cost Canadian taxpayers incurred filing these returns and preparing these returns that were, sent to garbage bin after all.
Oh no.
I don't want to misrepresent because I didn't look it up before the interview, but I will let you know it was an outrageous number. So outrageous that the taxpayers ombudsman is now investigating the process in which the rules were implemented and managed and drafted, and hopefully someone will be held responsible for all the money wasted
Yeah.
Because the rules were not ready to be implemented.
And as you say, the rules still exist. So even though there was a reprieve at the last minute, which, saw all that wastefulness, they haven't gone away. So are you hopeful that there will be some visibility to maybe making this a bit more reasonable and effective so we don't go through this again? Or you don't know. We just don't know what's going to happen, do we?
We don't know what's going to happen. I'll tell you more. There's this organization called Canadian Tax Foundation. Okay. They have annual conferences. It's an organization popular among tax practitioners in the country. All the CRA senior officials, all the Bay Street tax lawyers, CPAs, they all attend these events and conferences. I am presenting for the Ontario conference this year on the topic of bare trusts. And as I'm preparing my materials, I know that any day I can wake up to the announcement from finance that they revised the rules, rewrote the rules. So whatever I've done so far is no longer relevant. So
it'll go right in the trash bin with all those tax returns that no one used. How about that?
Yes. So I, from what I hear, and as I'm preparing for the conference, I'm talking to people who used to work for the CRA, or for finance rather, who have some connections within finance, and there are some unconfirmed rumors that we probably won't see the new revised rules very soon. We will see them, but probably not very soon. So but I think that towards the end of the year, we may see the revised bare trust rules that will hopefully at least allow those little old ladies who have joint accounts with their children not to file a very complex and confusing trust return, and not to spend a lot of money on lawyers and accountants to try and figure it out. So that's my hope, but happy to reconnect after I'm done with that article.
Hopefully they don't make new rules 6 days before the deadline. Do the reverse of what they did before.
Well, anything can happen there, and look at how the capital gains changes were rolled out. They were announced. We didn't have the rules. Then we had the rules, and 2 weeks before the deadline to make any changes. So at this point, I won't be surprised.
Yeah. And actually, and on that one, what was interesting is they decided that if you wanted the lower tax rate, you had to sell the asset, right? So we saw a flurry of, I didn't, but we looked in our accounts. It's easy for me to sell a security. I can hit a button. Well, not me, somebody else on my team. They don't let me touch the computer very much, but we can sell a security in seconds. But if you have a property or an apartment building, this was not easy to do. And I know there were a flurry of people trying to get transactions done, which was unfortunate because the finance minister could have just made an election. They could have just said, look, you don't need to sell the thing, just file the form and say that you did and then pay the tax. But I think they were really trying to drive in a lot of tax revenue. And I think indeed they were hoping in their budget that there'd be a big surge of tax revenue. Will be interesting to see if they got it or not.
It was a line in the budget. So the government consciously expected that additional tax revenue from people trying to sell, trigger, crystallize, we call it, capital gain before the June 25th deadline.
Yeah, and they were hoping to get billions of dollars from it. We'll see if they collected it. So let's just quickly recap. They did a great job with the capital gains changes. So that's scared some people out of Canada. We talked about the bare trusts and how poorly that was done. And I think for people that have a joint account or an entrust account, I guess they should wait and see what the new rules are, because if they got ahead of it last year, it turned out to be a waste of money. So maybe they should just be patient. So we've had a couple of really great things that they've done here. So one of the things you mentioned to me is, if they've been so effective so far, maybe we should give them more power. And you brought to my attention something that was also in the budget, which I hadn't heard from anywhere else. So good on you in seeing this, that in the budget, they also want to expand CRA's audit powers to a very high degree. So tell us a little bit about that.
I'll tell you one thing. We as tax lawyers are very concerned, and I'll tell you why. The CRA now already has a right to request an oral interview, not only of my client, but let's say of my client's family members or neighbors. So really anyone with knowledge that could be relevant to someone's tax liability. Very, very wide scope.
Wow.
That, just as we thought that the CRA's powers could not get any wider, we got this year's budget. And in this year's budget, there is a proposal whereby the CRA auditor can make you sign an affidavit. An affidavit, I don't know if your listeners know, is a legal document that you sign in front of a commissioner for taking affidavits. And before signing it, you swear that all the contents in this affidavit is true.
Yeah.
So that's the document that you can be forced to sign in the course of an audit without your legal representative present, without any safeguards, without anyone ensuring that your rights are met.
Protected, yes.
Without anyone questioning whether the CRA's auditors' questions are appropriate, not appropriate. So you can really, at first, you can answer all the questions verbally through an interview, and then you can have a piece of paper put in front of you.
Wow.
And the auditor will say, well, now you have to sign that affidavit.
And wait, this is in Canada. This isn't in some other country. This is here. Do we not have a constitution that protects us from this? This sounds very inappropriate and against what our rights would be.
The Canadian Bar Association thought so too.
Wow.
And they made submissions to the Minister of Finance stating that the rules as proposed are not constitutional. If they're adopted into law in the format that I've now proposed, they will challenge them as being in breach of the Charter.
Wow.
It's absolutely unnecessary, and it's very aggressive, and it creates so much room for abuse by the CRA auditors, and I don't. There's no point to subject anyone to procedures like that, especially given the fact that we already have an access to justice situation in when it comes to CRA audits. And people can hire lawyers if they have hundreds and thousands of dollars at stake. But what about people who have, who have to ask to pay back a modest amount, but still very significant for their family, but not large enough to afford a lawyer?
No, because it may be $10,000, but the lawyer is going to be more than $10,000. Exactly. So they're stuck. What do we do?
Yeah, and if on top of it, we'll make people sign affidavits, and then there's no, even the lawyer won't help them. If the lawyer comes in and the CRA will just pull up that piece of paper and be like, do you remember being swearing that this is true? This is what you signed. Remember you told us.
Wow. And given their clear professional and highly skilled at capability with capital gains and bare trust, we want them to have this much power. This is shocking to me that this is what's happening. So
sarcasm. I just read on yesterday in an accounting group that the accountants were discussing that the CRA call centers are currently offshore, and they were convinced that this is true because every time they spoke to someone, they could not understand the person's accent. I mean, I have an accent. I have a lot of sympathy for
well, and
people.
From your perspective, I have an accent, right?
But lately, every CRA representative we are able to reach have has an accent,
Yeah.
and it's so, and sometimes it's a very, very strong accent, and that people cannot understand. So the accountants that I work with, they're convinced that
They moved it
they're
offshore.
currently working from Bangladesh or from India, somewhere offshore, because
Wow.
of the accent. And then I had to correct them that no,
It's in
all the
Moncton.
CRA call centers are here in Canada, and it just happens that the CRA hired a lot of new people, new auditors, new representatives.
I thought you were going to say foreign students for a minute there, because that's another issue that I'm hearing a lot about. I don't know if it's true, but we have a lot of foreign students. I hope they're not taking those to CRA. I'd like people that have actually got, their designations and their credentials. But this is a frightening concept that they're expanding their powers to the point where all the lawyers are worried about it. So with that being the case, are there any other trends that you're seeing that, or is this just going to, do you think, continue? It's just going to become more and more difficult for people to be able to remain compliant and be able to keep their wealth?
I see trends, and some of them are worrying. Some of them I think is a good way to make sure that people who have to pay tax need to pay tax.
Sure.
And a lot of it is in the data analysis area. So the CRA has gotten much better at analyzing data. Mm-hmm. The CRA has gotten a lot better at requesting data from third parties, and they get quite creative. To the point that they're willing to request, the location of your parking permit for your construction vehicle, which would help them identify the number of construction projects the person was involved in. They get data from places like Home Depot on purchases of materials somebody made over the years, construction materials, which would allow them to make conclusion of the person's revenues and sales, right, and everything else.
Right. So if all those 2x4s wind up at their deck at the cottage, they're going to figure this out. Yeah.
True. So I mean, they've been selective at the size of the account that they are scrutinizing. All I'm saying is that we are moving into digital world, and all our life is now, there's data on everything we do. The CRA is getting smarter and smarter at accessing that data. And some people say, well, it's a good thing, and maybe we will see a tax system that's not as complex. And maybe we will see a tax system that would allow you file your tax return with one push of a button. And some people say, I'm concerned for my privacy. Mm-hmm. I don't want the government to know, the type of underwear I wear,
and the toothpaste I like, or this is right. We should have some sense of privacy to live our lives, right?
Exactly. And as
the first Prime Minister Trudeau said, the government has no place in the bedrooms of the nation, and yet they're under our bed.
True. Maybe not there yet, but we see a tendency within the CRA that more and more audits are being also initiated from data obtained from third parties, they call it. Okay. So they approach builders, they approach retailers, they approach city who issues permits, they approach even, there are certain ways when they can trace the number of people visiting your restaurant or passing through your office. All these things now can be measured and submitted to the Canada Revenue Agency, which is, on the one hand, maybe a good thing, because some people who clearly don't pay their fair share of tax should start contributing. But there must be a reasonable line there on how much we need to share with the government.
Well, and as we saw with the Bear Trust, they try it and they get way more people. As we saw with the capital gains, it's only this number. No, it's way more. So maybe precision could be part of what they're doing. I want to move to another area, which I think is really important, is how do people know when they should have, a tax accountant versus a tax lawyer? And is there a difference between like tax planning and tax litigation? Like, when would someone call you over somebody at H&R Block or their CPA at the corner? Where do you come into their planning?
If things are going really well and you're making lots of money and you think the world is your oyster, and you start thinking about, maybe I need to think about ways to optimize my tax situation, that's the time when you may want to speak to a tax planning specialist.
Got it.
It can be an accountant. Usually I would recommend someone who is licensed, i.e. a CPA.
For sure.
Or it can be a tax lawyer. The choice is yours. Some CPAs are excellent in tax planning, and they just work with lawyers who help them implement their ideas. So we create companies, we set out trusts, we prepare documents together with the accountants. Tax planning lawyers, they do the same, only it's like a one-stop shop. We do
they can do the planning and all the paperwork.
And we do all the paperwork.
Right.
So that's the tax planning, when everything in your life is going well. When everything in your life is not going so well, i.e. you get that brown envelope from the Canadian Revenue Agency, and in that there's a letter that says that you owe the CRA $1 million or less.
I don't know, but I think I'm like most people, that when you do get that letter from CRA, even it just says, you were checking your address or something, you get that brown envelope. I think for everyone, our heart rate goes up a bit. And it may just say you're getting your climate action initiative check or whatever the heck, incentive check, whatever they call it. But as soon as I see that brown envelope, I think I'm like most people, where I'm like, and then you open it. It's usually nothing, but it does scare you, because it's not the lottery you want to win. It's not the lottery you want to win.
Yeah, so that when you get that brown envelope, or you get a call from a CRA auditor saying, "Hi, you selected for an audit, I'll send you a letter."
Do they call? Actually, that's a good point, Anna. Do they actually call? Because I keep getting that phone call once in a while from somebody with an accent that always tells me, like, if I don't do something, they're going to cancel my social insurance number, which actually would be good, because then they can't tax me anymore. So they called me once live, and I said, could you do that by 3:00 today? Because it's payday. If you could just figure out a way to not tax me anymore. They hung up on me. So, but does CRA really call people, or is this, because I think they would need to protect themselves from fraud?
But the real CRA auditors always follow up with a letter and with that brown envelope.
Okay.
So we've had a surge of fraudulent CRA calls. 99% of, those were fraudulent. Having said so, sometimes the CRA auditor will reach out to you by phone and will introduce themselves, and they will say that I also sent a copy of the audit letter, watch out in your mailbox with my questions and everything else. So never, ever, ever provide any personal information or do anything or send any money based simply on a phone call with the CRA. If it's a real auditor, they will follow up in writing, and they will state your, whatever it is that they need from you.
So CRA doesn't want to get paid in Tim Hortons gift cards?
No, Bitcoin is also not their currency of choice. Ethereum maybe, but no, just kidding. No.
Okay. So I think I may have lost my money on that one. But this is important, because I think it's important people have the ability to protect themselves from fraud and make sure they're dealing with the right people. And that brown envelope, no one seems to have faked that one yet, but that might come too. But again, this is an area where having a proper tax lawyer, tax accountant to maybe go and ask those questions and say, look, I did get this letter. Is it legitimate? What action should I take?
Yeah.
Right.
And then once you get that envelope, I always tell people, go to your accountant. If you trust your accountant, if you like your accountant, go to your accountant first and ask them, how serious is this? It may be not serious at all. You don't need to spend a lot of money on that consultation with a lawyer. Or maybe it's serious. So the accountants are generally pretty good at knowing if something is outside of their, expertise, and sending them, and they would send the client to a lawyer. The only situation where I would not go to an accountant is when I knew that I did something really, really bad. So if I were to go to an accountant and share my story with the accountant, technically the accountant can be called to testify against me in trial. So the best thing to do would be to go to a lawyer, and whatever you share with your lawyer will be subject to solicitor client privilege. It means that nobody, not even the judge, nobody can force me to repeat what the client told me,
Right.
Subject to very limited exceptions. So if you know that you may have done something really, really bad, and the letter may somehow be related to that, the letter from the CRA, then go straight to a lawyer. Don't talk to anyone else. Go straight to a tax lawyer. And then tax litigation lawyers, we fight with the CRA. We always go against the CRA. We try to resolve the problem at the audit level. If not, we appeal. If not, we go to tax court. If then, we can go to federal court of appeal. If we're lucky, we go to Supreme Court. I have not been that lucky yet, but
I don't think the clients are that lucky to get there, but I can see it's like going to the big leagues as an attorney.
Yes. And criminal lawyers do get there way more often than us, but we're jealous for that.
But that's a very good component, though, or piece that people need to know, is that the accountant does not have privilege, but if they go to the attorney, their privacy is more protected than in any other place. So that's a very important distinction. And I think you made a good point that, if you're in deep trouble, come to you. But if you're successful and you need more planning to take advantage of the tax rules, to do it legally, also see you. So that's very good news.
Yeah, we'll try our best to help.
Perfect. Okay. Well, listen, we've had a good conversation today. Thank you very, very much. I'm a little concerned by a lot concerned about what CRA's new powers might be. So I'm glad that all the lawyers seem to be on the side of helping and protecting us. So thank you for that and bringing these to our attention. And I will circle back to you when we get maybe some more clarity on what the Bear Trust reporting rules are, and if there's any other changes to capital gains coming. So Anna, thank you for your time today. I really appreciate you being on with us.
Thank you so much for having me.
This has been Two-Way Traffic with Darren Coleman of Portage Cross-Border Wealth Management. Thanks for watching and listening. If you have any questions or comments or ideas for new episodes, send us an email at twowaypodcast@gmail.com. And you can find the Two-Way Traffic podcast on Facebook and Twitter. This series is a production of the Acme Podcasting Company.
On behalf of the Two-Way Traffic podcast and Portage Wealth of Raymond James, thank you for listening to this conversation. This podcast has been prepared by and expressed the opinions of Darren Coleman and his guests, and are not necessarily the opinions of Raymond James Ltd. Statistics, data, and other information presented are from sources Raymond James believes to be reliable, but their accuracy cannot be guaranteed. This podcast is for information purposes only and is not construed as an offer or solicitation for the sale or purchase of securities. Investors considering any investment should consult with their investment advisor to ensure that it is suitable for the investor's circumstances and risk tolerance before making any investment decision. Past performance is no guarantee of future results. Information provided in this podcast is general in nature and should not be construed as providing legal, accounting, and/or tax advice. Should viewers have any specific questions or issues in these areas, please consult your legal, tax, and/or accounting advisor. Raymond James Ltd. is a member of the Canadian Investor Protection Fund. Raymond James USA Ltd. is a member of FINRA and SIPC. Raymond James Ltd. and Raymond James USA Ltd. financial advisors may only transact businesses in provinces and/or states where they're registered.